Anita Stockton talks about risk and reward on the stock market. Interview with an expert. By John X. Pike. Published April 19th, 2012. Although the stock market affects all Americans, both those who invest in the market and those who don't, many people have little or no understanding of how it works. This reporter sat down with Anita Stockton, a retired stockbroker, to find out more about this important financial institution. What does the stock market do?
The stock market plays a crucial role in the global economy, enabling companies to raise money by selling shares of ownership to investors. The cash generated by sales of stock helps many companies grow, which increases competition and growth in the economy and provides consumers with more goods and services at cheaper prices.
Some people get rich from the stock market. How do they make money?
Owners of shares, or shareholders, seek to profit from investments in stocks, but there are no guarantees. Occasionally, some companies distribute dividends, a sum of money to shareholders for each share they own. Shareholders also sell their shares to other investors through a stock exchange, and they may revel in their profits when they sell for more than the original cost. Stock trading has become increasingly complex, with thousands of companies publicly traded and multifarious strategies available to traders. But buy low, sell high is a rule that will never become obsolete, and that investors will always commend.
Sounds like easy money. Is there risk involved?
Unfortunately, there is no sure way to predict fluctuations in stock prices. There can be reprisals for careless investing. The market can be an omnivorous beast that will pick clean the portfolios of the savviest investors. Even the wise lose more money than they gain, so putting one's money in the stock market is not for the ingenuous. Stock analysts measure the value of a company in terms of its assets, debts, and earnings. But such analysts cannot project future earnings with certainty. Nevertheless, when analysts determine that a company is likely to grow faster than its competitors, investors rush to purchase shares. Consequently, demand for the company's stock increases along with expectations for future performance, and the price of the shares rises. When the company's earnings are compatible with expectations, the share price may continue to rise. Investors keep their shares in anticipation of further gains or sell for a profit at the new price. Sometimes, a company's profits may fall short of expectations, and such results, once reported, can have a stultifying effect on the demand for the firm's stock. Apprehensive investors watch the value of their investment shrink as the share price drops.
What a roller coaster ride. Do many people lose money?
The uncertainties of the stock market put many would-be investors in a quandary. Some investors regard the stock market with animosity and buy low-risk investments with parsimonious payoffs like government bonds. Conversely, many a daring investor in the stock market has derided himself for his insatiable appetite for risk once he felt the sting of losses. The volatility of the market scares many investors away and punishes the imprudent.
With so much uncertainty, who invests in the stock market?
For many investors, the possible gains of the stock market prove too great to ignore. Disciplined investors balance potential losses against potential rewards. They diversify their investments, maintaining reasonable expectations and a moderate appetite for risk. They research the companies whose stocks they buy. In short, apathy is not recommended for potential investors. But if you have no interest in studying the market yourself, mutual funds and money managers can fill this role, affording you the opportunity to benefit from the power of the stock market and from professional expertise. Overall, cautious, prudent, and well-informed investment in the stock market has proven to be one of the best ways for investors to increase their wealth.